Hi, this is Sadiq Adesha, Chief Investment Officer for Sun Life Global Investments. As we begin to settle into a new normal, the markets are still showing signs of heightened uncertainty. In March, we saw the CBOE Volatility Index go above 80, which is quite extreme. Lately, it has been in the 30s and 40s, but that is still double the long-term average. As we move into the next phases of the pandemic, we continue to manage risk while looking for opportunities for the longer term. Join us as we present part 2 of our Quick Take series. At Sun Life Global Investments, we go through a rigorous process to select and monitor sub-advisors from around the world. In our Quick Takes conversations, these sub-advisors provide important insights into their regions or asset classes. We hope that this diverse coverage will help you manage and stay informed through this period.
Hello, thank you for joining us today as we speak with Product Specialist Scott Edgcomb from MFS to discuss the Sun Life MFS U.S. Growth Fund. Scott, how has the asset class been impacted by the events in Q1 2020?
Thank you for the question. The efforts to slow the spread of the coronavirus brought the U.S. economy to a grinding halt, leading to sharp declines in employment and economic activity, and a surge in jobless claims. The last 8 weeks saw U.S. jobless claims spike to nearly 40 million people. Spending habits have been completely altered and will likely remain so as long as we are collectively practicing some form of social distancing or operating below full capacity. The economy is eventually going to reopen and people will adjust to a new normal, but spending habits formed during the lockdown may remain out of necessity for those seeking employment and potentially out of a higher propensity to save rather than spend for those employed but less certain about the future. The U.S. growth asset class has fared relatively well, as many of the tech-oriented products and services have been less impacted by the lockdowns, lower interest rates, and lower energy prices. As we look for investment opportunities for our growth portfolio, we focus on profitable companies with unique and differentiated products and services that we believe have durable competitive advantages, attractive balance sheets, and favorable liquidity positions. Our experience investing through multiple cycles tells us that economic downturns do the most damage to companies with weaker business models, undifferentiated products, over-levered balance sheets, and an inability to adapt and remain focused on the long term. The ability to weather more challenging periods is critical to our pursuit of the best possible outcomes for our clients over the long term, and we believe our insistence on owning durable, high-quality growth businesses positions us well to endure these types of environments.
Are there any sectors or regions that are more attractive given the sell-off in Q1?
The growth team has been talking about this a lot, and we've made some opportunistic moves over the last couple of months in areas we think there is likely to be wide dispersion between winners and losers, and the macro conditions created attractive risk-reward opportunities. Within the tech sector, software and IT services are two industries that provided some level of defense during the first quarter, but we believe the opportunity goes beyond just defense, and it's important to be selective in what we own in the space. Looking for companies that can grow revenue, cash flow, and earnings over the next 3 to 5 years above and beyond what Wall Street consensus thinks they can. We're looking for companies that, 1, provide a critical product or service that's necessary to conduct business, saves customers money and or time, and automates manual workflows. Products or services that have clear market leadership and advantages in user experience versus alternatives. 2, companies that have scale from a resources and balance sheet perspective, with management that has long-term focus and the ability to invest and innovate through the downturn to take market share and become more relevant to their customers. And 3, a culture that puts customers first and demonstrates empathy to customers, employees, suppliers, and partners. We see this with companies developing COVID-19 specific innovation of new products or flexibility, knowing that customers and employees will remember how companies treated them in both the good and bad times. Outside of technology, we're finding opportunities in healthcare. And while we've long held overweights in the medical device and tool space, we've been adding new names in biotech and pharmaceuticals as we expect increasing pace of investment and innovation over the short, medium, and long term, both in biopharma and then also in areas like genome sequencing.
Have there been any changes to the fund?
The volatility from the first quarter has carried over into the second quarter, but we stick to our process. We continue to look for ideas where we think earnings will be higher over the next 3 to 5 years, with the understanding that there's very little visibility or certainty into 2020 earnings at this point. We focus on being directionally right over the next 3 to 5 years versus precisely wrong on the next year where we think there's too much time and attention across the marketplace focused on. We believe if we stick to what we do best and focus on the long term, we will be able to add value in our portfolio. For the remainder of 2020 and beyond, as different parts of the economy work to come back online, we think there will be numerous opportunities for us to identify profitable companies with attractive future growth prospects that have been mispriced by the market due to the ongoing macroeconomic uncertainty. Thank you for your time today.